Hello everyone, in this video I'll share 5 secrets to mastering scalping like a pro. These lessons took me 5 years to learn and you've likely never heard them before, as most videos only cover the basics of scalping and don't go deeper. I'll cover everything about each secret and then go over the examples. Let's begin. The first one, and again I've never seen anyone talking about this, what usually go over is that you need to focus on the quantity. So go over as much pairs as you can and then look for the opportunities. However, my advice for you is to master one pair. Mastering one pair means that you understand how that pair behaves. You understand how that pair reacts to the levels. So either it respects the support and resistance, or it sweeps them, or it closes below them and then close above, or it just go and sweep them with a wick. So you need to understand your pair. So you need to go over your pair, back test it, because the reality is that each of those pairs that I'm mentioning here and I'm going over, they each have their own behavior. So for example, if we're talking about the euro dollar, and all of those, because they open at a specific time, they're most volatile at a specific time, and we're going to talk about this in the next slides. So that's one thing. So if you focus, for example, on the euro dollar, and this is my favorite pair, this is what I trade the most. That's why when I scalp on the euro dollar more than the NASDAQ or gold. Why? Because I tend to understand how it behaves. So some of the things that you'll realize after time is that it typically sweeps the Asian range liquidity. So instead of breaking above or breaking below, which happens sometimes, but a lot of times it actually sweeps the Asian range liquidity and then it goes on the other side, creating the fake move that will establish the bias. So that is one of the things that we need to understand. So whenever we have that high created, which is the fake move, we know that the bias is bearish. Now, another thing is that you need to understand when is the time where the volatility is the max, because, and that is another thing that we're going to be going over later. Volatility is the key here when it comes to scalping. So we know that euro dollar is high volatility during London and New York session. Now when it comes to gold, and I do have a full video about trading gold, some secrets about it, we came to realization that gold respect market structure more than the euro dollar and more than the NASDAQ. So if you trade support resistance, if you trade market structure, it's going to be higher win rate for you and a lot of higher probability trades more than the euro dollar. Euro dollar more like a choppy one. It sweeps and then sometimes it closes below and then it fakes out. So it's a little bit not respecting the support resistance and the market structure. And gold also respects supply demand, respect order blocks, and it's actually high volatility during Asia, London, and New York. So sometimes you'll see that it has a lot of expansion in Asia, sometime in London, and most of the time in New York. And as known to everyone, gold gets affected easily by news events more than the euro dollar and more than the currencies in general. So you need to understand your pair. And I'm not just talking about this. There are a lot of things that I can go over the euro dollar, and maybe if you wanted, I could do a video about how to trade the euro dollar. I made one about the gold. Now, if you want one about the euro dollar, let me know. NASDAQ, we know that its high volatility comes in at 9:30, which is the market open, and it respects period raise, actually more than the other two here. It respects the period raise and especially inverse fair value gap. So I do have a book, Trading Inverse Fair Value Gaps. That strategy is higher in win rate and really high in win rate when it comes to NASDAQ, but it's not the same for the euro dollar. It's less in the euro dollar. It's more effective in NASDAQ. So this is one of the things that you realize after spending a lot of time in front of the charts in your pair. So just focusing on your pair, we go from there. Also, SMT divergence is crucial. So I do have a full video about SMT divergence. If we're looking at NASDAQ and then we're looking at S&P 500, and we can see one is creating a failure swing, the other one is sweeping liquidity, that's a major thing. We could scalp based on that indication. We know that price is bearish when we have that S&P divergence, and we could scalp on that. And it's going to give us some high probability opportunities. So the first one is simply understanding and mastering that one pair, so you know how it behaves and you know how to adapt to whatever happens. Now, secret number two is the higher time frame and the lower time frame, the relationship between quality and quantity. Probably the first time you've heard about scalping, you were told that it's all about taking a lot of trades and then making a lot of money in less time. That is what you've been taught, and that is not the real truth. Now, that is a lie. It's just something fancy to think that the market will give you a lot of opportunities and you will make more money the more trades you take. That is a total lie. The truth about it is that in scalping, we focus more on quality more than quantity. Because if you focus on the quantity, when you're focusing more on winners, you actually get a lot of losers and you might wipe your account. You might lose a lot of money in one day, and then the winners are going to do nothing. They're not going to make up the losses. So it's all about quality over quantity. And what I mean by that, by understanding the relationship between the higher time frame and the lower time frame. In this schematic here, what we see is that we have a lot of opportunities. So I could long from here, I could short from here, long from here, short here. But the thing is that we're not getting shorts from here exactly. So we're not catching the top. No one can do that. We might get an entry here, and then this is what we get, and then price takes the stop loss. Now I could again short here, but it's actually not here. Stop loss is above here, but we might enter here. This is only what we're getting, and then stopped out. So instead of focusing and putting a lot of energy in the small moves, what we can do instead is focus on quality, which means that focusing on the higher time frame. It's all about the time frame alignment, about the higher time frame to the lower time frame. So scalping is not about sitting on the 15 seconds or sitting on the 1 minute chart by itself. That's not scalping. It might be scalping for some people, but if you really want to make money off scalping more than just impress some people, you need to focus on the higher time frame, and there is nothing wrong with it. So what we're going to do is we have the blue to the green one is the higher time frame bullish POI. POI is point of interest, a zone in the price action where I'll be interested in taking action. Now this one is a higher time frame bearish POI. So the same thing, but it's bearish. It's one that most likely will push price lower. So by understanding the higher time frame bullish POI and the bearish POI, and then the time frame alignment would be 15 minutes, then 1 minute if you want to scalp. Okay, you could do also 5 minutes and 1 minute. Now sometimes you could also do 1 hour and 5 minutes, but I don't want you, 1 minute, but I don't want you to go higher than this because it's not going to be a valid one. Now this one is a 15-minute fair value gap as an example. This one is a 15-minute order block. What do you notice here is that the expansion and the big moves always start from the higher time frame POI, and anything in between is a noise. If you understand this, you are already on a next level when it comes to scalping. Everything in between is a noise, and the real moves would be from the higher time frame POI. You see here, noise, real expansion, noise, noise. There is a small expansion to the lower side, real expansion. So you see, if you catch this instead of catching this or trying to catch this, if you just focus on this, maybe you enter here, stops below, that's a big move all the way to here. If you take this one, that's a loss, or at least break even. This one is the real move. It starts expansion. Now same thing here, expansion. Instead of catching those small ones here, you focus on this one, you focus on this one. So now I'll go to trading view and show you how this is so obvious on the charts. Okay, now this is the 1 minute chart. If you try to catch every move here, it's going to be, first of all, most likely your head will explode because there are a lot of moves. Are you catching this short or this long or this long or this short? There are a lot of moves, and a lot of times it's ranging, so you won't make a lot of money here. However, you see that sometimes, as an example here, price comes here and then expand higher, and again price comes here and then goes lower aggressively. So how can I only focus on those ones instead of being in this noise, instead of getting a headache, right? So removing all drawings here, if we focus on this day here, so this is the current day, that's yesterday. If we just switch to 1 hour first, okay, you'll notice one thing. You'll notice that we have this order block, we have an aggressive move to the upside. We sweep liquidity here, we have an aggressive move to the downside. We have this order block here, we have an aggressive move to the upside. I mean, now switching to 15-minute, for example, because 15-minute will give you the refined POIs. You see how this low here, inside of a fair value gap, being taken into an order block, that is a move you want to focus when it comes to scalping. Now, it might be taking longer time, but this long time will equal to more money. So it's an expansion to the upside instead of getting into this noise. Now, I know this is a fair value gap also, and it's not going to be all the time price comes and then go aggressively, because there was a lot of news also in New York. That's why it was not the best day on London. However, you see, even though we were ranging here, but it also established some expansion. And after sweeping this low, that is another expansion to the upside. Now focus on those. Again, same thing here. We have this fair value gap, establish expansion. We sweep liquidity, and this is using the 15-minute. You see, 15-minute sweep of liquidity. We scalp from here, and you see, this is the move you get from here to here. So that is going to be the focus. It's going to be trading the higher time frame POI with a lower time frame confirmation, and then scalp it from there. Now the third secret, and it's actually not a secret for a lot of people, but people still making this mistake because they want to stay in the chart and make money as much as possible. They tend to trade in times where there is no volatility, and we need to understand that volatility equals money. So whenever there is volatility, whenever there is a move in the market, you can make money that move. If there is no significant move, you'll be maybe hitting a lot of stop losses, maybe a lot of break evens, and it's going to compound and add up to a lot of commissions and fees. Okay, so that's why we need to focus only on volatility. And there are different types of volatility. Now, one type is focusing on when the market is open. So as an example, if you're trying to scalp the US indices, then you're not going to do it in the Asian session. Not going to do it, before London. I mean, in London, it has some volatility, but mostly you want to focus on the market open at 9:30 a.m. EST. That's when the market is open. That's when there is a lot of volume. That's when you can make money, because there is a lot of volatility. Price goes up, price goes down with an expansion. That's the time you can make money. Now, when it comes to commodities also, gold mostly, it's volatile during Asian, London, but mostly on New York. Now, Forex, if you're trying to trade the euro dollar, for example, I don't tend to trade the euro dollar, for example, in Asian, because sometimes it can be high in volume, but most of the time it's not. So you want to focus on London and New York. Now, anything with USD, so you can go euro USD, pound USD, and then anything with USD at the beginning or at the end, that's going to be most volatile during New York session. Euro and pound volatile during London session. Now, low and medium impact news, again, that is another part of volatility. It's news. Low and medium impact news can create volatility. So that means you can trade the low and medium impact news. However, avoid high impact news, especially the big three. So CPI, NFP, and FOMC when scalping, because what can lead to, maybe you'll make a lot of money, but if it goes in the other direction, other than your trade, it might wipe out your account. And why is that? Because when it comes to scalping, we're going with high risk, which means high lot size. If price goes against your direction, you might lose a lot. If you trade with a funded account, let's say 100K, when it comes to scalping, you go with 5, 10, sometimes 15 lots, because we're going with a very small risk, okay? And we look for a lot of reward. This risk here is very small, and what the news can do is make it like this. This is your risk, and this is where it goes. That's a lot of risk, and you might lose your account in one single news event. Secret number 4: high resistance liquidity run and low resistance liquidity run. How can we use this? Before getting into this concept and the importance and the significance of it when it comes to scalping, we need to understand how does liquidity work. If we look at this, what we can see is that we had this high, right? And we had liquidity above it. What happened here is that there is a process of transferring the liquidity from this high to this high after taking that high. So in other words, what happened here is we had liquidity here and it was transferred to this high here. There is no more liquidity here and it becomes here now. On the other hand, if we look at this schematic here to the right, what happened is we have liquidity here, and because it was not taken, there is no process of transferring the liquidity here. However, what happened is we had more liquidity here. So it's a trend line, same as a trend line, but the more we go lower and the more we create failure swings, we have more liquidity build up here. That is how liquidity works. So in this case, what happened is there is no more liquidity here. It was all taken and now we're ready to go lower. Okay, so the moment you see liquidity sweep creating a high followed by a breakout structure, and this sequence here is the formation of a strong high. So whenever we have a sweep followed by a breakout structure that happens in no time, that means we have a creation of a strong high. This formation of a strong high here is the high resistance liquidity run, and this is a high resistance liquidity condition. What that means is that do not try to trade against this high resistance liquidity condition. Whenever you see this, you cannot go long here. Why? Now, sometimes it might work, but we trust in probabilities, and based on probabilities, this one here is lower because we create a strong high here. All the liquidity is taken. We need to go to the other side, and you see here, same thing, high resistance liquidity run. However, on this side, what we had is low resistance liquidity run. The rule of thumb is that we need to trade on a low resistance liquidity run on that side. So we want to target the low resistance liquidity run, and we want to enter on a high resistance liquidity run, which means that we enter after the sweep, we target the low resistance liquidity, or in other words, failure swings, or in other words, the liquidity trend line. So if you really want to backtest it, go to the chart and try to look for something like this, where we have a buildup of liquidity, where we have a trend line, and look for this formation of a strong low, for example, or a high resistance liquidity run. Whenever you see this, you will notice that after that, price tends to go aggressively to the target, taking all those liquidity, because the more we go up here, the more fuel we get. Fuel, 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 fuel. So it gets faster the more liquidity we have here. So again, the rule is we enter based on the high resistance liquidity run, and we target the low resistance liquidity. Now, one example about the difference between the high resistance liquidity run and the low resistance, and you can see it clearly here, and that is only on the 1 minute time frame. You can see that we create a high here, lower high, and then another lower high and a lower high. What you notice here is this kind of a trend line liquidity, okay, from here to here. A trend line liquidity where highs are not taken, which means that we have a buildup of liquidity. The moment we sweep a liquidity here, and then we break structure, you see how the momentum was here, how fast the price action was in order to take all of those, because this is all a buildup of liquidity. It's a fuel in the market. The moment we have this low resistance liquidity condition, it means that we're going to take it with speed. Now you could see also this on the higher time frame. So any time frame you can see this. You see how we have a buildup of liquidity. We have a low, higher low, and then a higher low, and a lot of lows here. This looks like a trend line liquidity, right? The moment we have, actually we had a high resistance here, but we did not break structure. So we took liquidity, yes. But then at this point, what happened is we take liquidity and then we break structure. And you see how fast it was to take all those liquidity here? Very fast. So the moment you realize that, and you see here actually, I'm not interested in buying. And why? Because it's all of this high resistance liquidity. See, we always reject the highs, and then reject the highs. However, here we're creating liquidity to be taken. So your direction will be on the side of the low resistance liquidity condition. Okay, so I'll be targeting the lows, which means that I'll be going short. Secret number 5, market structure and scaling. So whenever we are scalping, the most important thing is to be with the market structure. So we need to understand market structure in order to go with the trend. It's one of the most important things. So 2 slides ago, we talked about the point of interest, and it's actually related to this. So the moment we can see that we are breaking lows, I want to be trading on that side. Breaking lows, I want to be trading on that side. What we are seeing here is a market maker's model. I do have a full course about it, consists of 2 videos. If you are not familiar with it, then you need to watch that video. In the market maker's model, I always want to be with the market structure. So I want to be selling on the sell side of the curve, and I want to be buying in the buy side of the curve. So let's say we are bearish and I want to go long. I'm not interested here. As we are breaking lows, and then sweeping highs, and sometimes we have SMT, I'm not interested in buying. But the moment we come into a higher time frame POI, and you see how now we are relating everything together and connecting everything together, we have this higher time frame POI. Whenever we see sweep and then formation of a strong low or market structure shift after a sweep, we can buy here. So this is a buying. After we break a structure, we can buy again and look for sweeps of the lows. So when it comes to scalping, we always want to be on the right side of the curve. We want to buy here and then sell here. So the moment we have 2 recent breaker structures in one side, that is the trend we want to trust. I'll be entering here, and entering here. I'll also show you how to scale in, how to take multiple trades on the same direction when we can trust in the trend. So scaling, when to scale in. Actually, whenever you see this is the sell side of the curve, we're not interested in buying here because we're breaking lows again. Breaking lows. Here we have a sweep and then a breaker structure. You could buy here. Why? Because we're reacting of a higher time frame POI, as you can see. Now the focus would be the lower time frame POI, and they need to be in the same direction. Lower time frame POI here. Lower time frame POI. What is going to happen is, you see how we're having this trend line or low resistance liquidity condition. This is the high. This is your ultimate target. And what we're going to do is focus on the lower time frame POI, entering here, and then a breaker structure. Now we have 2 breaker structures. That means this is the trend POI here, scaling in, entering more with a tighter stop loss, betting that it's going to continue. And it's not just randomly betting, but it's based on the structure that we're having and based on the probabilities. Now you can see we come again to another lower time frame POI. We can enter here, going higher, and all of those trades, this one, making money, reaching the ultimate target. And we have this example in the Australian dollar. We had a sweep of liquidity followed by a breaker structure. This is the time when I start looking for trades. This is an extreme fair value gap. We have also this fair value gap here. We can have a market maker's model from here to this low, or we can have it, and this is all based on the confirmation, from here to here. And we're going to see how it goes. So in the price action, we can see that we aggressively go to the fair value gap at the top, go into the 1 minute time frame, and now you see we're taking advantage of the higher time frame and the structure. I want to see a market such a shift here, and then I would be scaling. Okay, targeting what? This low, which is the lowest in the market maker's model here. I'm looking for price to go to this low and maybe lower if you have any target to the left. Based on this, I want to see, first of all, a market structure shift. Now, this is the high. The last pullback is this one. So if we see a closure below this, that is going to be market structure shift. However, what happened is, okay, we sweep the high. Now, this is our market structure shift, which is closing below the low. And it looks like this is what happened. Now, obviously, we have this fair value gap. After a market structure shift, maybe entering here with a stop above the high, and then targeting this one. Okay, that is your first entry. Now playing the price action, you can see that we get to that fair value gap, and then actually we go a bit above into the fair value gap above. Now we can see that we create another fair value gap here in case you want to scale in more, but I've entered on this one because we take this high into the fair value gap. That is another entry model, so we could put it above the high. Now in my opinion, I want to focus more on strong highs and strong lows. So whenever we going up, okay, so something like this, and then here we get a market section shift. The condition I want to be participating in is this one here. Whenever we create a strong high, I want to scale in. Whenever we create a strong high, I want to scale in, and same thing here. So whenever we have a sweep on the right side, I want to be entering. Okay, sometime I want to look for fair value gaps. In this case, it's not really the strong high, the strongest one. This is a strong high here. That's why I entered. You see, price going lower. We also create another fair value gap. I might not be entering all fair value gaps. I might actually, you see how we fill this fair value gap fully and then create another fair value gap here. I might take this one also. So all of those are not 1% risk. They are less in risk. I'm going to put it above this high because this fair value gap is fully filled now. There is no reason for price to go higher. This is an example of scaling. Okay, so we have 3 different trades as of now. And then playing the price action, you can see, for example, here we have this high, we create this high, we take it, and then we close below. That is an example of a strong high. Now, strong highs are not going to be perfect, especially in the 1 minute time frame. There is a lot of noise here, but that's an example of a strong high, and you can look for a trade after that. Now you see price actually start going lower. I'm not gonna be interested in taking, for example, this one, even though it might be a low resistance condition because we're getting very close to the target. You could have taken this one, and you see after a little bit of time, it hits the target all 3 trades. So that's how you scale in. We make sure that we are in the right side of the curve. So that was the buy side of the curve here. The sell side of the curve is from here to here. That is the sell side of the curve. That's it for today's video. I hope you learned something new. If you do, and if you think that is a useful video, then make sure to share it with some friends, leave a comment and hit the like button, subscribe to the channel. This is Mulham, and I'll see you next video. Bye bye.